Good morning, everyone. Thank you very much for joining us again. Some of you have been on quite a few of these, but for the new folks on this particular webinar, the format is we're going to have about a 35-minute discussion, and then we're going to open it up for questions. Thank you for the folks that have sent in your questions. We have 25 questions that were sent in prior. We'll also take live questions, which if you're new to Zoom, I'm sure you're not, but if you are, the Q&A function's at the bottom, just type them in. And hopefully we'll cover a lot of them through sort of an organic conversation. A little bit about myself. My name is David Scherer. I'm co-CEO and co-founder of Origin. Origin Investments invests in multifamily in the Southwest, the Southeast, and Texas. We have 6,000 units that we own and operate. We have another 2,000 units in development. So a lot of the conversation will be around multifamily, but I'll also want to broaden it. Because Lance Patterson, who I'll introduce in a moment, is an expert on all aspects of real estate, whereas I'm really a specialist in multifamily. A little bit more about Origin. We have 4 active funds. Fund 2, Fund 3, our Income Plus Fund, and our QOZ Fund. We have $1.5 billion of assets under management, and we've been a top decile performer in Fund 1 and Fund 2, as measured by Preqin, who's sort of the market standard in measuring fund performance, which they group by vintage and also strategy. In 2019, Preqin designated us a consistent top performer, which we're proud of. So with that, I want to introduce Lance Patterson, who I value greatly as a partner. Lance founded Patterson Real Estate Advisory Group in 2009. A commercial real estate capital advisory firm based in Atlanta. Excuse me. Probably that's a live TV issue. Patterson is prolific throughout the Southeast, and under his leadership, the firm has grown to 20 professionals. They've done over 300 transactions, representing over $6 billion in capital placement across all asset classes. Lance's career spans 40 years in commercial real estate. Lance, I find that hard to believe, but apparently it's true. You don't look a day over 50, so I don't know how you started this whole thing. As it relates to Origin, and then we'll open it up for discussion, we've interacted more with Lance in the Southeast and his team than any other capital advisory group. They helped us with our capitalization on Centrum. An office asset was purchased in 2014 for our second fund. And again, with City Center Buckhead, both the initial financing and the refinancing. And then they brought us countless opportunities with sponsors and developers throughout the Southeast, as well as programmatic development opportunities and preferred equity development opportunities. So just to give you a flavor of how we interact with firms like Lance's, it's consistent, and there's a lot of value on both sides. So Lance, thank you for taking some time out of your business schedule.
Sure. Thanks for having me.
So I'm gonna jump right in. I think probably the biggest question right now is what's happening in the private real estate market, and what are happening to capital flows as we enter a phase which I would characterize sort of as normalization, or at least the beginnings of normalization. So take us through sort of the last few months of 2020 and then Q1 2021. And please be broad, because again, my domain of knowledge is really multifamily specific. You can touch on that, but please be broader.
Sure. Okay. Well, if I can, maybe I'd like to go back even a little further than the end of last year, maybe to when COVID really became the thing, which was March of last year. And I think up until that point, a tremendous amount of capital in commercial real estate, but it all stopped briefly for equity, a little bit longer for debt. But I think it's probably interesting for people to get a quick perspective on how that came back and into what it came back. So for our firm, like everybody else, from mid-March until maybe the end of April, we saw a pause. We had, like you, Dave, a ton of transactions we were working on. Most of those paused. we couldn't have said if we were going to close another thing at the end of the year. That was probably how a lot of people felt. But by early May, we began to have conversations with capital again. And for the most part, equity capital, I'm going to focus first on that. If you would have talked to them early May of last year and asked them what they wanted to do, the answer would probably universally have been distress. I want to wait until the end of the summer. That was really the talk, because people were confident there'd be a lot of distress and that'd be what they would focus on. That conversation changed probably 30 days later to where the idea of a lot of distress began to go away, and the thought of being willing to look at new development financing began to come back. But equity capital, for the most part, was somewhat proud of the deals they thought they'd be able to make, meaning they thought that they could get the better end of the bargain with the development community and felt that they might be the only equity source available, which was not true. And then by maybe midsummer, that had all changed to where equity was flowing pretty well, if not aggressively, and became more aggressive really through the balance of the fall and into this year. But I think importantly focused, as you know, Dave, on two main product types, the one that you focus on, multifamily, and on industrial. And that has been, I would just say, in my almost 40-year career, as active or aggressive or even rabid as I've seen it. And I think it would be interesting to just mention why that might be the case, or put it into perspective this way. So I pulled up some data that was put out by NAREIT. If the audience doesn't know, that's an industry association that tracks data. And this morning I pulled this up, and there's about $16 trillion value of commercial real estate in this country. Multifamily is the highest percentage, but at about 18%. Office is 16, retail 15, hospitality 10, and industrial 9. So take industrial and take multifamily, that's 27% of the value of the commercial real estate in this country. Yet it's largely been 100% of the equity interest the last 6 months. And so I think that by itself tells you almost everything you need to know on why pricing has gotten so aggressive in those two product types. It also tells you that capital is looking to expand into maybe doing some other things, because it's so competitive, so difficult for capital to win transactions and get deployed. Debt capital's been a little different. Just touch on that briefly. From a permanent loan perspective, multifamily has always benefited from having a lending source that no other product type has. Fannie and Freddie, sort of always there. So that's been helpful. Life companies have been willing to make loans on multifamily and industrial, but we're seeing all of the debt sources back in the market now this calendar year. Banks, debt funds, life companies, permanent loans, construction loans, it's all back, and it's all very aggressive. But again, largely, not solely, but largely interested in these two main product types, multifamily and industrial.
Yeah, and we've seen the same thing. We're not in industrial, but we're in multi. What I saw was in Q4, you could still get deals done. You could still buy deals. We're very active in preferred equity too, and that was still it was competitive, getting more competitive, but it was still hanging on to sort of that uncertainty of COVID. And then January 1st, everything changed, and by February it was obvious. And we'll go over that in detail. Mm-hmm. Actually, why don't we do that now, since we're touching on it? Claire, if you don't mind, can you put up the two slides we have on multifamily, please? So this will speak a little bit to what Lance was just talking about. Cap rates, which equate directly to the price paid. It's the multiple on NOI at any given point. It's also the future expected value or net present value of cash flows the market has. And that's driven by the cost of borrowing, but also the long-term growth rate associated with markets. And so, as I said earlier, we're in Texas, the Southeast, and the Southwest. And that's why we intersect so heavily with Lance and his significant operation in the Southeast. But if you're looking at these are both our own internal machine learning growth rates of markets. And then we also compare those to other licensed solutions that you can buy, Axio and others. CoStar does it, Reese does it. But this is Origin's own AI machine learning tool. And we bring in, I'll actually do a webinar on this as well, but millions of pieces of data are brought in to come up with what the machine, not us, in an unbiased way believes specific cities and submarkets are going to grow by. These are pretty high growth rates if you take the median here. Southeast, obviously, Texas, a little bit lower. There's a lot of variance in sort of the mountain Southwest. I can tell you that markets like Colorado Springs are on sort of the higher end of this range, on the sort of 3.5 to 4.5, at least in our own AI. Denver is actually quite a bit lower, which might surprise people, but affordability is an issue in Denver now. So, you know, when I'm talking about growth, I just want to define this. I'm talking about rent growth. So all these different ways that people look at growth, population growth, job growth, where the rubber meets the road in multifamily investing is, does it equate to rent growth? And rent growth also incorporates supply and demand equilibrium, right? Because you can have all the population growth you want, but if supply is growing faster, you won't have rent growth. And so the model has to look at all of it. And then obviously Phoenix and Las Vegas are the highest. And it's pretty efficient in the sense that if you go to the next slide, Claire. So the first slide is really it's speaking to what we estimate growth to be. And that's an unknown future, right? So millions of pieces of data and our expertise are going into those, but it's still it's uncertain, it's in the future. Cap rates are the multiple played on earnings today, and it's certain. It is the price you will pay. Much in the way if you buy a stock today, you don't know future growth, but you do know the price you're paying for the stock. And so what we've seen, and I would argue, Lance, and please tell me if you disagree, this cap rate compression, so when you're thinking about the Southeast, 50 to 75 basis points from really Q3 of last year until today. Texas, 50 to 75 basis points. The Mountain West, we say 50 to 100, but again, that depends on cities. And certainly 50 to 100 in Phoenix and Las Vegas. So massive amounts of compression. So whether or not there's growth in the future, what is certain is the market believes there will be growth in the future. And that's why cap rates keep compressing. The other reason they keep compressing is what Lance said earlier, which is there's just massive amounts of equity that needs to find assets. And it keeps driving assets higher and expected returns lower because it needs to be allocated. And so, Lance, do you disagree with any of these estimates, first of all, and sort of why this stuff is happening, or do you have anything to add to that?
No, I don't disagree at all, and I think your time frame is right on. This has all happened in a relatively short, well, very short period of time. It's not like, as you said, it's been a constant. It has been a constant decline, but this real rapid decrease that you show here on this slide has really been since, as you said, last fall, and it's been pretty material. You know, one thing I would say, which I will admit, I certainly look at industry data, but I don't spend all my time studying industry data. What we do though, is we talk to multiple capital sources every day about all sorts of things, and we close lots of transactions. So we have a pretty good idea of what is happening. And if you look at that feel of what's happening, as you said, tremendous amount of capital. But if you look at the actual facts, the capital in the commercial real estate industry last year was down, and it was largely down because nobody was doing office, nobody was doing retail, and I'm exaggerating, but this is largely true. Certainly wasn't doing hospitality. So overall, it was down, but it was tremendously up for these two product types, and that's why you're seeing these compressions in cap rates.
Yeah. And I'll also add, if folks were on any of our webinars last year, one of the things we were talking about last summer, and we were doing these monthly, so June, July, August, the multifamily market even then was unchanged to slightly higher in terms of asset valuations. In terms of operations, operations were much, much lower in terms of cash flows. People were having to offer concessions to keep the properties 95% occupied. And then just because of the non-eviction moratoriums, you also couldn't evict renters. So non-paying renters couldn't be evicted. And so bad debt was accumulating, and that was affecting cash flows. You're getting less cash flow. And so there was differing information sets, right? You had asset values going up, you had operational metrics going down, virtually in all markets. I can name a few that were exceptions. Colorado Springs is one, Phoenix is another. But Lance, I think you would agree, broadly, on a cash flow basis, it was lower.
Yes, yeah, it sure was.
And what's happened, and it happened so quickly. I've been doing this not as long as Lance, but a long time. I want to say 15 years. I've never seen operational metrics turn around that fast. And it happened about, it's market by market, but Chicago, which is a lagging market, it really happened 90 days ago. And the Southeast was probably more like 120, 150. But overnight, there's no concessions, and rent growth is pretty significant. I mean, I was in Dallas yesterday. We're raising rents 9 to 12%. I mean, and I'm not talking about through burning off concessions. I'm talking about base rate rents. They're going up 9 to 12% on new leases today, and they're significantly higher than were a year ago. So that's one thing that's changed. The other thing that changed from last summer is public REITs, and there's not a lot, but there's maybe 5 to 7 publicly traded REITs, apartment REITs. There's many more in different asset classes, but they were trading down 30, 35% from February 2020. And that's a conundrum, because if you're looking at the private markets, public REITs own private assets, and they capitalize through public markets. And so they compete with us. Why is their stock down 30% when asset values are going up in that asset class? It's a conundrum. Well, as I sit here today, those public REITs have rallied 40 to 50%. The answer is they're not. And everything is pointing up. Operations, valuations, public market proxy, it's all consistent. It's not a conundrum anymore at all. Now, I don't know what the future holds, but there's no inconsistency. Does that make sense?
Yeah, there is. I'll point something else out that's obvious, but I think it's worth just mentioning. So the states that are shown on this slide are the regions that you focus on, and the region that we largely focus on, the Southeast. That is where people are moving to. They have been for many, many years, and they've been moving to these places for job opportunities or weather or whatever it's been, and all those things are still great. But what's happened recently is they're not just moving to these places for the things that are good about them, they're moving out of places they no longer want to be. And I think you see that in the Census Bureau data yesterday, if anybody followed that. Certain states lost seats. This happens every 10 years, and some states gained seats, and the states that gained seats are largely these that are on your slide where you focus. It's where people are moving, and it's not just the people, but companies are as well. And it's job creation, it's all sorts of things. And so I think this is going to continue. I feel pretty good that we're going to be in for a really good run in the markets that we focus on.
Well, I completely agree. We're headquartered in Chicago, and I'm a big Chicago fan. I've lived here over 20 years, but we lost a seat in Illinois. We almost lost 2, but we lost 1. And I believe since 1970, we've lost a total of 5, because it's a population trend that's leaving. And I actually view, I'll go further than that, I view the virtualization of the workforce, which will wind up being a hybrid workforce that does there's more flexibility. So it's an accelerant to the population flows. If we wanted to see regression back, the catalyst would have had to have been something else. The catalyst that we had actually will increase population flows to the Southeast, Texas, and the Southwest as they look for better lifestyle, better weather, and importantly, lower state taxes. And that's what's driving all these things, and it's just going to increase. Lance, we just got a question on industrial on the live feed, but if you can maybe speak a little bit about industrial as an asset class, and also touch on hotel, retail, and office, because I will simply listen. I don't have anything to add.
Sure. Well, here's an interesting one for you in industrial. And again, I mentioned I don't read as much industry data as I probably should. But another thing I noticed this morning, which is just remarkable, you think about just get in your car and drive around your community and just look at the real estate. And you get this sense that most of the real estate in the country are these big buildings or all this sort of stuff. But in the for what it's worth category, the single family value of real estate in the US is over 2 times the value of commercial real estate. Thought that was interesting. But industrial, I mentioned earlier, it's 9% of the value, it's 30% of the square feet. And I think that's important to keep in mind of all commercial real estate. So office, hotels, apartments, retail, industrial, all commercial real estate. Industrial is 30% of the square feet. And the point of that is almost all those buildings are single story and they need a lot of land. And so if you're going to develop new industrial, you tend to have to get a pretty big site, and more to do that in the urban markets like in Atlanta or Chicago or wherever. You've got to go further and further out from the urban core. It just gets harder and harder to do that, which does drive this last mile thing that we talked about. That plus obviously all the things we buy online. It just makes a lot of sense when you think about it to have a smaller industrial facility in an urban market. But in terms of investor interest, I will start by saying I do believe that the investment community has been prudent. We're not seeing a lot of silly deals or stupid deals. I'm sure there are some, there always are, but for the most part, the investment community has been very, very prudent, debt and equity. That said, if you've got an industrial deal you're trying to get capitalized, you will be overwhelmed with interest today. And it almost doesn't matter where or what. It does. It always does. But it's just very, very hard for capital to win those deals. The buildings may be big. The dollars are small. It doesn't cost that much to build an industrial building. And so that is another reason industrial is so interesting, is people want a lot of it, but they just can't fill up the dollar volume bucket that they would like to, because the dollar sizes are just not that big. But industrial is leasing really, really well. It's the companies, it's the Amazons, whatever. But industrial has some of its issues too. I heard something the other day. This is amazing. Those roof truss systems that hold up the roofs in industrial buildings, Amazon is apparently buying every one of those they can get, and they're stockpiling them, which means that other people who are trying to build industrial buildings can't get them. So, you've got stuff going on in every market, but industrial, for the reasons that are just obvious to the people who are on this webinar, very, very popular for the tenant and consequently very, very popular for capital. The southern markets are seeing this. I'm sure the northern markets are as well. That may be a product type that is able to do a little bit better all over the country, but clearly in the South, industrial. As great as multifamily is, I think industrial is probably the product type that capital is most interested in. Office to me is really the key. It is a big part of our industry. It's a lot of space. It's a lot of dollars. It's been a really interesting last year in talking to people about office. In 2020, capital inflows into office were down, decently down. And they were down largely because equity wasn't sure how to underwrite. What does the future office building look like? And I think the good news is you rarely ran into anybody, and frankly, I don't think I ever ran into anybody who thought that office buildings are going away. Nobody thought that, but people did have legitimate questions. Dave, you mentioned it earlier, the virtualization of working, are people going to all work from home? And that's a valid thought. Certainly a lot more people will work from home more often than they used to. Absolutely. On the other hand, will people in office spaces want more space? Do you really want to sit in that open floor plan 3 feet away from 30 other people? Probably not. So you're seeing companies expand their office space to build cubicles or real live offices again, where people don't sit next to each other. That's happening. And what does that mean in terms of the net amount of office space we need? I don't know. Short buildings seem to be a little more popular than tall ones today. That's an obvious statement, but it's true. Buildings in the South a little more popular than buildings in the North. That's true. So all of that is kind of trying to get settled out, and ultimately it's up to tenant demand to dictate the direction of the office investment, because once the tenants begin to make decisions on their leases, then people will know how to underwrite office. And that does seem to be happening for the most part. Last year, if a tenant didn't need to move, maybe they had a maturing lease, they probably went to their landlord and asked for a 1 or 2 year extension. That was the most likely thing they would do. Now we're seeing beginning stages of tenants make decisions on moving their space, expanding, or whatever. That's going to bring office back into the fold. It's beginning to happen, and I think that's very, very important. Hospitality. Boy, Atlanta, I'll pick on our city, which I love, but Atlanta has 7 hotels downtown that are big convention center hotels of over 1,000 keys. Those are really hurting because no conventions are happening. Brutal, brutal difficult for those hotels. If though you have a hotel in a resort area, you probably are doing really, really well. The Nashville hotel market is doing fantastic. It's almost back to where it was in 2019 already. So it kind of depends on where it is, but the hospitality world seems to be coming back. And I think the vaccinations and all that are going to allow the business traveler to come back, and that will help on hospitality. And then retail, a little bit of a tale of two worlds. You've got the home improvement places doing well, grocers have done well. It's the bars and the restaurants that have struggled, obviously, but I think those are beginning to come back as well too. So to me, retail may be a little bit harder for capital to figure out, but we're seeing some life in retail again. But I would put industrial back as, again, the most popular product type for people, and office is coming back, which is probably the best news for our industry.
So let's take it a layer down. Equity and debt by asset class. And I don't think we need to cover multi and industrial. The answer is there's a mountain of equity and a mountain of debt. And that's what's driving these valuations higher. But let's talk about the other 3 food groups that you mentioned. Office, maybe we start there.
Yeah.
What is the equity outlook? And also the debt outlook, where are the spreads? I can tell you in multi stabilized assets, as you know, you can still borrow it, anywhere from, what I'm saying is, let's presume it's 60% leverage with a cash flowing asset. You can borrow 3.5, 3.6, 3.7, 3.8, and even in development with not even non-recourse but completion guarantees, you can borrow sub 3%. So it's very, very open. Take us through office, hotel, retail.
Sure. So office development, if we were to have called a lender or equity last summer and asked if they would entertain financing an office construction deal, if it didn't have 80% or higher leasing, we would have been laughed off the phone. You're no longer laughed off the phone. You may not get too far on conversations with a lot of people, but nobody's laughing you off the phone any longer. And you will have good conversations with some people. So that's one way to think about it. It is coming back. There is some equity that thinks it's contrarian to look at investing in office. That's probably a little too severe, I think. We are aware of some speculative pure spec office transactions getting financed in Denver as an example.
What are the spreads, Lance? Like, where are you getting an interest rate on a spec, or even like, let's start with the pre-lease office and then a spec office.
So you mentioned on multifamily non-recourse. So for the audience, when Dave and I talk about that, what we mean is that nobody has to guarantee that loan, which is a wonderful thing if you're the developer and a riskier thing if you're the lender. The banks in the US right now, for the most part, they've always been recourse lenders, have always required a repayment guarantee. Now, if the leverage gets real low, you can probably get away with non-recourse lending from the banks. But Dave, for that spec office building, it's unlikely that's a bank lender. That's probably a debt fund. You might find some banks, you know, the most premier developer and very, very low leverage, 50% maybe or less. You might get non-recourse financing on a spec office building, but it would only be in a few markets in the US. But that pricing probably for that spec office building, that means no pre-leasing at all, is probably in the high 4s, 5% range today. So decent.
So that's come in a lot. I mean, there was a period where it was, if you could get it, 8 or 9%.
Yeah, that's right. It has come in quite a bit. Boy, hospitality in terms of equity, one of the ways we look at it is what is the projected yield on cost. And so back to the slide Dave showed earlier on multifamily, you saw those cap rates. A really important metric in looking at development stuff is what do you think the property will yield? And so you clearly hope when you're developing that it's going to pencil to a higher yield than what you can sell it at, the cap rate being the sales number, the sales yield, if you will. And generally, we have in our industry looked for a margin of, call it 150 to 200 basis points. Maybe on industrial, it's lower, multifamily maybe a little bit lower. But if you think you're going to sell it at a 4 cap, you kind of hope it's going to yield a 5.5 or 6, give or take, right? So on office today, you probably are hoping it's yielding about a 7, which may or may not sound high. I don't know how that will strike the audience here. But it's hard to get things to pencil there. And I know we'll talk about this in a minute because construction costs are so high. They're high on everything, everywhere. So, and that's a big reason why it's tough to get office financed, is because it drives the rents to need to be high. And back to the comment earlier, capital just isn't yet sure where rents are going to be. Hospitality, on the other hand, that return on cost probably needs to be a 9. So that gives you a little bit of a perspective. And multifamily, it's certainly 6 and probably less today, depending on what it is and where it is. I think the only types of lenders that'll look at hotel financing today, again, it'd have to be in a resort kind of a market. Maybe it doesn't mean it's in the Bahamas or something, but it's coastal Florida, vacation kind of a place. Savannah hotel market's been good. Charleston hotel market's been very good. Places where people have been willing to drive and vacation. Those hotels have generally been doing pretty well. So if you have something in a market like that, that might get financed. Retail, I think on a development basis, it's going to probably have to have a grocery store as part of it to get that done. I think a traditional open air lifestyle center, difficult to get done today. Mm-hmm. But you'll see the pricing. So I mentioned those returns on cost. The pricing probably will follow that. My guess is on a hotel construction loan today, that's probably 6.5% on the interest rate. So it just kind of keeps going up.
So to me, the conundrum with retail is, for so many years, we've heard that experiential retail will kind of be the repurposing event of a lot of the retail that's moving online, right? The problem with that is experiential retail is historically the worst credit. Yeah. So as a landlord, you're essentially funding a space, TIs, et cetera, for a restaurant or an experiential concept that most likely won't, I mean, I'm just saying historically doesn't last more than 3, 4, 5 years. It's not a business that I would want to be in. I don't understand it.
It's weird. So I'll tell you, over the course of my career, this is funny. This is way before my career, but I don't think we had regional malls in our country until maybe the 50s into the 60s, and then you began to see them. So everything was open air. before then. So that's what it was. And then the big stuff kind of all went to regional malls. And I probably don't need to get into that. That's, boy, that you talk about brutal. Ugh, that's a difficult business today. But early in my career, I remember the thought of trying to get financing on a retail center full of bars and restaurants was laughable. People would say, you can't get anybody to make a loan on that retail center. It'll never happen. And then up until COVID, that was the only kind of retail you could, it was all this experiential stuff. You know, if you weren't full of bars and restaurants, then it was hard to get a loan, because if your tenant base was stuff you could buy online, those retailers were struggling. And so it kind of shifted to that was the type of thing everybody wanted. I think it'll settle out to where we're all going to go back and use that experiential retail again. It just needs to kind of find its time.
Yeah, I agree with that. I believe we're going to normalize. It's just, I think even in the non-COVID world, it's not a great investment because historically small businesses failed before, all small businesses before 5 years, and restaurants are more risky.
Mm-hmm.
And so when you say these words like experiential retail, what you're really saying is food is probably your primary. Food. And those are purpose-built spaces with not great credits and sure expectations for growth and earnings. All right, I'm going to move on. Let's talk about development. We touched on it. Mm-hmm. And Lance, I don't care where you focus. It can be in any, I'm guessing development would be, the discussion would be predominantly industrial and multi, because that's where most of the capital and lenders are investing. I can tell you that we believe development is by far the best place to be investing right now. Mm-hmm. I'll tell you why too. If you buy a 3.8 cap tax adjusted multifamily, and let's just presume for a second that there's a lot of equity and lenders that are providing fuel to drive up asset classes. And let's just presume that they're driving it up 10%. And so there isn't a recession, there isn't anything. It's just the capital sort of finds the assets it wants. And in 3/4 of the prices normalize and the prices are going down 5 to 10%. The problem with that is when you capitalize 2-to-1 debt to equity, which Origin does, when an asset goes down 5%, your equity is going down 15%. Because your equity is the first loss, it bears all of it. Mm-hmm. And that's a very likely scenario. I'm not saying that it will happen. I'm just saying, would you agree, Lance, that that's a reasonable statement, that it could be that there's slight normalization and equity finds what it wants, and then all of a sudden it trades a 3.95 cap, not a 3.8 cap. You literally would be telling your investors at a constant NOI that they're down 15% in 5 months. I don't want to do that. And I think that's a reasonable outcome to what I'm seeing. Could be wrong, but I'd rather, I think the spreads in development are quite big. You mentioned 150 to 200. I agree with that. Most of the things that the things that we like in the markets that we like are sort of a 5.7 to a 6 cap. I mean, that's sort of defensible conservative underwriting, with the big caveat, and this is everything's working except input prices. Mm-hmm. Right? Yeah. And that's the big X factor. And maybe you can talk a little bit about how violent it's been in the last 8 months.
Holy cow! Yeah. I'll make one comment. It always, I need to do this as frequently as I remember, because it strikes home to me. So the difference between a 3.8 cap and a 4 cap, you might say, hey, whatever, 3.8, 4, it's 5%. If you have a $60 million deal, that's $3 million. So let's think of that. The difference between a 3.8 and a 4 cap, it doesn't feel like much, but it's $3 million. Okay. And that, as you said, that's a big hit on the equity. And Origin, of course, is the best that I've ever seen in terms of being able to correctly value things, but maybe even Origin isn't always able to know if it should be a 3.8 or a 3.9 or 3.7 or a 4. I mean, the market is just not that great at these things. You just don't know. And so you do run a risk, particularly in a time when pricing has fallen as quickly as it has. Development, on the other hand, if you've got this spread, as you talked about, and you should, frankly, because there could be things go wrong in development. You could have cost increases. It takes a year and a half or so to build one of these apartment properties. Let's focus on that. Then you've got to lease it. That takes another year, year and a half. So it's 3 years from when you start to when you've leased it up. A lot can change that nobody can predict. So you do need that spread. You want that spread. It makes a lot of sense. But you've got that buffer to where you can afford to have some variation. And who knows, maybe the cap rate environment continues to go down. The big issue today in multifamily, and really in all product types, multifamily is seeing it as much as anything, is lumber pricing. If anybody's been following it, I think until last summer, nobody was following it, but we began to then, because it was really the first time you began to hear of these rapid increases in lumber. So for the audience, a way that lumber is priced, and this is just boring 2x4s, is on a price per board foot. And a year-ish ago, right before COVID started, that price was about $325. There are indices that track lumber pricing. One of them is the Idaho Pacific something or other index or whatever. There's several that you can go look at. The current price per board foot is over $1,300. So in 1 year, it's gone up 4 times. And that is a multi-million-dollar increase in the cost of a pretty traditional suburban stick-built apartment property in the markets that Dave and we focus on. It's millions of dollars. And kind of getting to the point we talked about earlier, that can be a brutal thing in terms of your returns. And so we've seen these yields on costs that we're underwriting decline pretty rapidly over the last 9 months because of this increase in lumber pricing. And it's the weirdest thing. I mean, you can kind of understand it, but we're not short of trees. That's not the issue. There's more lumber on the stump, I heard somebody say yesterday, than we've ever had. The price, if you are a timber grower, the price that you get if you want to sell your lumber to the sawmill is the lowest it's been in 50 years. So you're not cleaning up. You're not making any money. It's really sawmill capacity that's the issue, and that's the log jam. And they're making a lot of money, and they're just holding these prices up. So where is all that going to go? You hear all sorts of people with all sorts of ideas, and I certainly don't know. We all hope it comes down. I think the bulk of the discussion or evidence or whatever might tell you it's more likely it's going to come down by the end of the year than that it will continue to go up. But it's a difficult situation right now. And to put it even more into perspective, if you're looking to start construction on a big project, a big apartment complex, you don't just decide the day you want to build one and tomorrow start. It takes you 6 to 12 months from start of the idea, probably more like 12, maybe longer, from when you think you want to do something to when you can start construction. And during that time frame, you're trying to get the site entitled, you're trying to get the property designed, you're trying to get it priced, you're trying to find your loan, you're trying to find your equity, you're trying to find all these things. And during the last year, this entire time, your lumber price has been going up and up and up. And even when you think you're close to closing the financing and getting started, you may only be a month or two away, but a month or two ago, that 13 and a quarter per board foot pricing was probably $1,100 a board foot. So it continues to go up, and it's just making it challenging for people to know where their costs are going to be. Now, the good news is once you start construction, not always, but usually you can lock in the price. But there are some debates and discussions. Do you want to lock in the price, or do you want to hope it comes down? And who knows? How much risk do you want to take? You know, and we've heard stories of people who last fall, when it had already gone up quite a bit, were pretty convinced it was going to go down, and they decided not to lock in the price and started construction. And then that hasn't turned out to be a real good decision. So it's a big issue. I would say it's probably for apartment development, not probably, I think it's by far the biggest issue right now is the lumber price. And it's not just lumber, it's other materials too. It's lack of labor. it's all of these things, but lumber is really the big one right now.
Right, I agree. You're right. I'm glad you said that. Lumber is a huge one, but steel is also up a lot, and so is labor. And a lot of the subs, because they're so busy, it's driven by construction, multifamily, industrial, but also residential construction. There's a lot of subs that are very busy, and if you want to get their attention, they're charging you a lot for their labor at this point.
Yeah.
Importantly, the other two metrics that go into the valuation are rents and cap rates. And as we saw earlier, rents are going up and cap rates are going down. And so that whole equation, I can tell you even now, we're still, even with the lumber, and Lance is absolutely right. On all of our deals, we're seeing $2 million minimum overages on lumber alone. Right, so she's absolutely right. 60 million, 70 million, $80 million deals, that's what you're seeing. But the return on cost spread to stabilized cap rates to our underwriting, which I believe is pretty conservative for a lot of reasons. Maybe we'll talk about that separately, but we don't trend rents. We drift cap rates higher throughout the whole period. Still is 170, 180 basis points, even with the increased cost. What will happen though is if input prices keep going up faster than cap rates go down or rents go up, you're going to see deals not get done, right? Because all of a sudden the equation doesn't work and capital doesn't want to take that unit of risk for 130 basis points, right? And then it's a self-correcting mechanism. Like, let's take it through. So less deals get done. And what happens when less deals get done? There's less demand for lumber. There's less demand for steel. There's less demand for labor. And all of a sudden, those prices start not going up as fast initially, and then eventually they start coming down. All of these things work themselves out, but the shock to this particular market was demand increased at a time where there's limited capacity of lumber mills, and COVID exacerbated it because of the inability to staff them 24/7 because of COVID restrictions. People couldn't be next to each other. And so it started to create a logjam, and it's still there. Okay, so we have a ton of questions, Lance, and I know we covered a lot of what we wanted organically.
Sure.
So I'm actually just going to fire some questions at you. These are the ones emailed in prior. Mm-hmm. All right, I know we covered one about cap rates, so we'll move on past that. Let's talk about variable versus fixed debt and what you're seeing in the market in each, and how you see the interest rate curve affecting real estate decisions on capitalization.
Yeah, so just quickly, development debt is almost always priced as a variable rate, versus permanent debt is almost always priced as a fixed rate. So differentiate between those two. And it's largely because of the risk profile and just the fact that once it's built and leased, it's still a risk, obviously, but you're going to a different type of lender at that point. So just keep that in mind. I would start by saying, gosh, in my career, I remember when Treasury rates were more likely to be 7% or 8%. That was not at all uncommon earlier in my career. So that today, even though they've run up decently since last summer, they've come in a little bit. These are Treasury rates. So if you're going to do a fixed rate deal on an existing asset, they're still very, very low, and spreads are very low. I think that's very important to keep in mind. It may feel a little bit higher than it was last fall, but it's still very, very low and very attractive. Again, primarily for multifamily, because it's the only product type, the only one that you've got a government agency willing to make you loans on. You don't have that anywhere else. And it doesn't feel like Fannie or Freddie or HUD are going away. So they're always there. And that's a really important thing for people investing in multifamily. It keeps things from getting too far out of control. On the floating rate basis, you're probably borrowing, as you said earlier, Dave, at sub 3%. Which is fantastic. You know, maybe LIBOR or SOFR or whatever we go to, which, by the way, that won't be the only new index, but whatever the index is that you're borrowing over, it's still going to be pretty low. And so these rates are very, very attractive on a long-term basis and still provide accretive yields.
Are you doing any HUD loans as well with multi?
We don't. Well, I take that back. We're doing one. It's in Mobile, Alabama, a place we really like, but a little bit harder to capitalize. It's an apartment development deal, obviously, since it's HUD, but we've looked at some, but we're really not a Fannie, Freddie, HUD kind of a group.
Yeah.
So I'm familiar with it, but not that expert.
So the challenge with HUD for us, because we are talking about it, because both of our funds, Income Plus and QZ, are long-term investors. And so that's obviously a fit. Rates are, I agree with you, are very, very low. And as you know, HUD is even lower than the agency,
Yeah.
which is interesting because you can go out further at a lower interest rate. But the challenge with HUD for us is kind of twofold. One, generally HUD, you start with fairly high debt levels, call it 80%. We don't use that high debt level. So like right off the bat, it violates our covenants on the risk side. But then if you start lower, because obviously they'll start lower, the problem is you can't resize.
Yeah.
Right? It's very difficult to resize the HUD loan. And so like if you think about, you have a 30-year loan, and over time, maybe it starts at 65 LTC, but over time it goes to 60 to 55, 50 to 45. What are you gonna do? Right? So like it's this conundrum. You're sort of incented to start at higher leverage. And that's, from a risk standpoint, that's not great, right? Because if things go wrong in years 1 through 3, you're high leverage.
So what we have done quite a few times is a construction/permanent loan with a life company. So it's not dissimilar from the HUD program,
right.
The life company. And you can usually get, I shouldn't say usually, you can sometimes get that life company to agree to a resizing mechanism. You create a formula and certain metrics and all that. And then if you hit that period of time, you can go to the life company and you've got a contractual ability to get them to lend you more money. You don't know the rate. They won't commit that rate because this is going to happen probably years in the future, but they will commit a formula. So you can get that, and I fully agree with this, life companies are in the business of making loans. This is what they do. So if you do a construction perm from a life company today at 60% of cost, and then 4 years from now, the value's gone up and you want to borrow more money, you just go to that same life company and say, hey, will you increase the loan? Odds are pretty good they'll say yes, because that's what they do.
So your point is it's variable during construction, and then but you're fixing the perm rate today and you can resize. Is that what you're saying?
Well, it's like they'll actually fix the rate during construction. That's the only time. It's fixed the moment you start construction. It's fixed at that time for a 10 or 12 or 30-year period of time.
Right.
Fixed rate.
Yeah, that's a really good point. And it's something that we're going to explore as well. We should talk offline. We have a lot of assets that we need.
It's a great thing for an OZ deal because obviously those are meant to be held longer term. Most development, not all, but most development, the developer's looking to sell the asset once it's built and leased, so 3 to 4 years in. But for projects where the development capital wants to hold it long term, something like a HUD or a construction perm with a life company, I think can make a lot of sense because you get your rate locked, you take that entire risk off the table.
Different question. Are we in certain markets and in certain asset classes, are we in a bubble, Lance?
I don't think so. We haven't had many new office buildings or hotels built the last year. I mean, nothing new has started, right? So anything under construction in those product types started before COVID, and nothing new has started recently, and very little is likely to start. So I think those product types are fine. Multifamily or industrial are the ones that you might think there's been a lot of construction, but you made a great point, Dave. You feel like there's a gazillion things being done, maybe more in industrial than multifamily, but it is brutally difficult to get to the starting line. on a development deal. It takes a lot of time, a lot of money, a lot of effort. There's a lot of risk. And so the thought that if you want to build an apartment property, you just snap your fingers and go build one is not at all the case. It's very hard. And the construction cost environment's making it harder. And so I don't really see that we're out of whack on any product type, at least in the markets that we're talking about. It's just not the case.
Mhm. We have time for maybe one more question. We had quite a few questions on opportunity zones. So can you talk a little bit about your work in opportunity zones, really in any asset class you want to go with?
So a buddy of mine, good client, I'm going to say it was June of 17, I think, called, maybe it was June of 18, I should know this, but he called, his name is Scott. He said, hey, Lance, have you heard of these things called opportunity zones? And I'm like, yeah, Scott, I think those are those things where you get tax credits for job creations, right? He said, no, it's some new law that was passed and has to do with investing in real estate. And I'm like, no, I hadn't heard of that. It's, stupid me and stupid Scott. And about a week later, all we were hearing about were opportunity zones. It just, floodgates opened and it became the thing. And everybody and their brother wanted to do opportunity zone investing, and you had a lot of people. It was kind of Wild West in some ways in terms of who was trying to do this. And it kind of came, and it didn't go, but it settled because, like everything, it became harder to actually do it in reality than you thought when it was on paper. But it feels to us, and I don't think it's just a feel, it's definitely the case that it's come back. Even before the talk of the last week or so with the potential increase in capital gains, I'll touch on that in a second. Even before then, opportunity zone investing has been coming back to where it's found a good place. And if you've got a transaction that is in an OZ, it is a very valid way to go try to get your deal financed. We've probably financed 7 or 8 transactions with OZ capital, but we've also financed 7 or 8 deals that were in OZs with non-OZ capital. So it's a great additional source. My belief is it's going to become more likely than not that if you're in an OZ, you're going to be using equity that wants to take advantage of the opportunity zone regulations. And again, if you look at the potential increase in capital gains rates, we'll see. But you go from 20% to 40%. And then if you're in the state of California or New York, where you can tag an extra 13% of state taxes on top of it, plus the ACA tax, and you start to push 55% tax rates on your capital gains, that's brutal. And I think, and you're already seeing it. We're hearing and reading that tremendous amounts of capital are trying to get into opportunity zone investments for this very reason. So you hope that if that law does get changed, that it starts next year. I mean, who knows and all that stuff. None of us really know, but no question, I think that opportunity zone investing is gaining even more momentum.
Yeah, I agree with you. Even the timeline. We stumbled across it on a deal in Charlotte in January of 18. So I think it was part of the 17 tax law. And I was talking to a developer in Charlotte, and he said, and by the way, it was in NODA, and we wound up buying that land. But he said, by the way, this is all in a QOZ. And I turned to Dave Welk and said, I have no idea what he was talking about, you. And he said, no. And we called our general counsel that day and said, you? And he said, no. And so everyone was trying to figure this stuff out. We recognized pretty early that the play was to tie up the best sites, because there's a limited opportunity set of high growth sites that happen to also be QOZ. And maybe it's another webinar, but in the last 5 months, we've seen a record amount of capital flowing into our fund. And I can only, I'm pretty sure that's indicative of that's happening with lots of OZ funds, right?
Yeah, and like I mentioned, this is even before. I mean, certainly the talk about increasing the capital gains rates is accelerating it even further, but this has been happening even before then. And maybe there was a little bit of a thought that it was going to happen, and that's why people were doing it. But it clearly is an interesting thing. You know, what I wonder about, I've heard nothing about this, so have no idea, but it does strike me that it could be that the boundary lines of some OZs might, I don't think they change any that are already in place, but do they put other locations that are not now in QOZs into an opportunity zone? I could see that potentially happening, because if you look at the maps, and it's all public, you can go pull it up. You know, where are the opportunity zones in Illinois or Chicago or Texas or wherever? Pull up the map, and they're all drawn and they're all set, but do those change? Maybe.
Well, you mentioned earlier that there's been a new census, and there's reps that increased and decreased state by state, but the opportunity zone maps were also drawn by the 2010 census, as they should have been. 2017 law. Well, now there's a 2020 census that would be far more accurate at the goal of helping galvanize lower income neighborhoods with capital gains as a new capital source. It would be logical to say, well, actually, let's use the 2020 census, which would completely redraw all of the maps. I don't know if they'll do that or not, but it won't be retroactive. I mean, you can't do that. But you could do it looking forward. The challenge with doing that is most of the benefits for opportunity zones are tax forgiveness of future profits. Mm-hmm. It's not equity into a deal like a tax incentive would be. And so be careful what you wish for as sort of the social agent or the politician in this process, because if you think that the capital is going to come in with just a tax reduction on future profits, there are no taxes on no profits or losses, right? So I can just tell you right now, we won't invest. It still has to be a viable project that makes a return on equity that's commensurate with the risk.
That's right. Yeah, there's no doubt that in every QOZ conversation we've ever had, the capital is not just doing silly deals. As I mentioned, it's not happening really anywhere. It's certainly not happening in QOZs. It's got to be a deal that they believe pencils. Right. That's important. The question is whether, and we haven't really seen this much either, but it makes sense that it could happen. Does the QOZ capital, or is it willing to take a little bit of a lower return? Right. Yeah, maybe. I could see that happening, particularly, if you're thinking the capital gains rates are going to double.
That's right. And we don't do that. We look at deals. I mean, I'll tell you, we need to get a 2.0 multiple on equity over 5 years, even though QOZ is a 10-year hold. Yeah. We look at everything the same for consistency of the lens. And candidly, after the first 5 years, it's a core asset. It's not a development deal at all. Right, you have a cash flowing asset for the next 5 years to comply. That's our hurdle rate. So you can talk about it as we did earlier in terms of return on cost spreads to capital rates today. Lance, I believe, used the word yield spreads, same idea. Mm-hmm. Or you can take it further and say, well, wait a minute, based on these spreads and this level of debt to equity and this borrowing cost, I believe we can get to a 2.0 multiple, which is really, as an investor, that's really what you want, is to multiply your capital. And that's how we look at it. I can tell you that the net present value of QOZ taxes, the not paying the taxes, the deferring the taxes, the reduction of your initial capital gain, people have estimated it. It's significant. So if you were an investor saying, well, actually, I'm willing to accept a slightly lower return because I value post-tax returns, that's a completely rational position. Yeah, absolutely. Well, thank you so much, Lance. I know we're a little bit over. No. We did have about 20 questions we didn't cover, but I do think that a lot of the questions interrelate, and the big themes were covered. Thank you so much for your time and more importantly, your expertise in the markets. Okay. It's appreciated, and I look forward to talking to you soon. Absolutely. Thank you all so much.